Hey, investment property owners, this is Jeremy Goodrich, owner of Shine Insurance. In this video, we're going to dig right into the number one insurance mistake I see people making. They make it all the time. Probably 25 to 50% of the people who come to Shine Insurance and ask us to look at their portfolio, the insurance on their portfolio, have made this mistake. And it might sound like Greek, but by the end of this video, you'll understand. That mistake is insuring with ACV coverage for the market value of your property. What the heck does that mean? Well, let's dig right into it. Let's set a scenario, and then I'm going to explain three key terms, and we'll show you what it looks like to do it a bunch of different ways. So the scenario is you bought a 2,500 square foot house for $125,000. Maybe you bought it from your grandma. Maybe it's not in the best shape and you're going to fix it up. Whatever it is, you bought this 2,500 square foot house for $125,000. Now, if we had to rebuild this house, now it depends on if it's on the side of a cliff in Oregon, like over the ocean, or in central Indiana where it's flat. Obviously, it's going to cost different amounts to rebuild that property in different places in the country. But we're going to say, for this scenario, that the house would cost $300,000 to actually replace. That's about $130 a square foot. Is fairly standard for a builder's grade house in many parts of the United States. And so that is a fair number to use as a part of our scenario. All right, let's get three key terms out of the way right from the jump. And these are important terms as a part of your insurance policy, so we're going to figure it out. And the first one is ACV coverage. This stands for actual cash value coverage. And ACV, simply put, means that we're going to depreciate. The insurance company is going to depreciate the value in a claim scenario for the age of that house or that thing. So let's look at that real quickly. So a house burns down. It's going to cost $300,000 to replace, as we described, but it's 75 years old. So the insurance company is going to say, well, we're going to depreciate for the age of the house. And after we do that, we're going to pay out $100,000 because that house is 75 years old. It's super old. And so we're going to depreciate. And so that is a lesser payout than the better payout, which is replacement cost coverage. Replacement cost coverage is the better. It says, well, if it's going to cost $300,000 to replace it, we're going to pay out $300,000 to do that. But if you have ACV coverage, they're going to depreciate for the age of the house, and they're going to bring that down. I don't know exactly what it would be for your 75-year-old house, but it could be $100,000. You lost $200,000 in that claim situation because you had ACV coverage. All right, that's the first term, ACV. Now, the second term is market value, and you may say, duh, I know what market value is, so fine. What a property is actually worth, right? Market value is what a property is worth. That's fine. That's great. But the thing you have to understand in the insurance world is insurance is not built for market value. It's not built around market value. It is built around replacement cost, what it would cost to replace the house. So if we use the example of a 2,000 square foot house and it's going to cost $250,000 to rebuild, then the replacement cost in this example is $250,000. That's what it's going to cost to rebuild. If the market value, what you could sell it for, is $125,000, well, that's great. That's the market value, $125,000. Maybe that's what you bought it for. Maybe you got a great deal on it. Or maybe that's just what you think you could sell it for. Whatever it is, those are market valuations. And one of the things I'm trying to get at in this video is that market value is not how insurance is built. And so it's important to understand that so you can make smart decisions as you put your insurance policy together with your advisor. So we've got ACV coverage, depreciation for the age of something. We have market value versus replacement cost coverage, what it's going to actually cost to replace it as opposed to what it's worth on the market. And then the last thing, this little sneaky thing, it's awful, but you have to understand it to understand investment property insurance, and that is the coinsurance penalty. And the coinsurance penalty is a part of insurance policies that penalizes you for underinsuring a property. People long ago said, well, hey, it's going to cost me $250,000 or $300,000 to replace my property, but I'm just going to insure for $50,000. And as long as a claim is less than $50,000, I'll have coverage. It'll be cool. And if it's more than $50,000, well, maybe I have some cash sitting aside, I'll just have to deal with it if that. But my insurance premiums are going to be so much lower if I just insure for $50,000 that's how I'm going to do it. And just like so many insurance rules, insurance companies saw that, had some claims that happened with that, saw that people were doing that, and they're like, okay, well, we got to create a rule that responds to that. And so the coinsurance penalty was born. And the coinsurance penalty basically says, look, and we're not going to get into this. I'm just going to breeze over it. There's a whole nother video on my channel on coinsurance penalty. If you're a nerd like me and you want to just dig in, great. I'm going to come back to this, but right now I'm just going to zoom over it. So, the coinsurance penalty figures basically what you did insure for divided by what you should have insured for times whatever the amount of the claim was equals the actual payout. And if you didn't insure for what you should have, that number, if you have a little bit of a math brain on you, you realize that number goes down pretty quick, and we'll give you an example in a second. So we've got, what do we have? I forget. ACV coverage, depreciation, right? And we've got market value versus replacement cost, what it would cost to replace the house versus what it's actually worth on the market. And then we've got the coinsurance penalty, the dreaded coinsurance penalty that is built to take away your ability to underinsure. And so those are the things that are going on. So let's look at some scenarios and see how this plays out. So scenario number one, we insured for replacement value, which is $300,000 in our example. And we have replacement cost coverage, not ACV. There's not going to be any depreciation. We have replacement cost coverage. So we insured for $300,000. Bad thing happens. House burns down. Claim is going to pay out the entire $300,000. Obviously, without with no coinsurance penalty, because you insured for the total value of what you should have, and of course, it's going to be minus your deductible. So whatever your deductible is not a major focus of this video, but obviously that would come out of the claim payout. So if you have replacement value and you have replacement cost coverage, then your claim is going to pay out what it will cost to actually replace your house. Okay, so that's one scenario. Let's look at scenario number two. We're going to insure for replacement value, but it's got ACV coverage. So we insured for that $300,000. We're paying for the insurance that it would actually cost to replace our house, but then we get a discount kind of for putting ACV coverage instead of replacement cost on there. And the claim pays out $125,000-ish. There's no coinsurance penalty because you insured for what you should have, the $300,000, but we depreciated for the age of the house. If it was a 75-year-old house, then it could be, claim pays out at $125,000-ish. Now, if you paid $125,000 for that house, maybe you're fine with this. Maybe you're like, hey, I paid $125,000 for this house. Yeah, it would cost $300,000 to replace it, but I'm not going to replace it. I'm cool with just getting my money back out of it. And I guess the only thing I would say about this is you've got to remember that out of this $125,000 in this example, you're still going to have to pay for the cleanup. Your town, your city's ordinances are not going to let you leave just a burnt down house sitting on a lot. So you're still going to have to pay to clean it up. And that's usually $30,000 right there. So after paying to clean up, even in this scenario, not, the next scenario is even worse, but even this scenario, you're left with under $100,000 from what you have. And there's no house. It's just an empty lot at that point. But replacement value with ACV coverage, at least you kind of made back your investment in this example, which is what a lot of people talk about. You listen to the podcast and they're talking about ACV coverage. It's like, well, make back your investment. Don't forget that you're going to have to clean up that lot, and then you're going to be left without a house with maybe the money you had in it before and maybe even less. Now, here's scenario number 3. This is the worst case scenario, and this is what I'm saying is the number one mistake that you can make with insurance on an investment property, and that is market value and ACV coverage. And so in this example, we say, well, let's just insure for $125,000. We're just protecting our investment. We bought it for $125,000. Yeah, it's going to cost $300,000 to rebuild, but come on, that's a ton of insurance. I don't want to pay for all that insurance. Let's insure for $125,000 so I can get my investment back. Well, you know what's going to happen is that in that scenario, the claim will actually pay out somewhere around $52,000 minus your deductible. And you say, what? why would it pay so much less than what I insured for? And it comes back to that co-insurance penalty. Remember, as a part of the claim, they're going to use this co-insurance clause and say, okay, what did you insure for? What should you have insured for? Multiply that times the amount of the claim, and that's going to give you the actual payout in the claim. So let's do that in your market value with ACV coverage scenario. So what did you insure for? Well, you insured for $125,000 because that's what you had in it. You thought that was a good idea. The insurance company says, what should you have insured for? And they say, well, $300,000 is what it would have actually cost to replace this house. Then we multiply that times the payout. Well, your limit on your insurance policy is $125,000. So the highest amount that payout could be is $125,000. So that is the number that is going to go in right there. And that's where it burns you, right? So if you take $125,000 and divide it by $300,000 and then multiply it times $125,000, you get $52,000. You insured for market value, you had ACV coverage, and you got burned in that claim by the co-insurance clause. You had $52,000 left, and guess what? Your house is still sitting there burnt down, and so your city is going to require you to clean that up. That's going to be $30,000. You're going to be left with $22,000 and an empty lot for your $125,000 investment. And that's what I'm talking about. That is the biggest mistake that you can make, right? Is to end up with $52,000 minus your deductible, minus what it's going to cost to clean up the lot for a house that would have cost $300,000 to replace. So why not insure properly? Yes, it's going to cost more money to insure properly, right? So what is the number one mistake you can make? I'll say it again. And so many people make this mistake. So if your insurance policy is set up this way, no big deal. It's okay. We can fix it. But the number one mistake is insuring with ACV coverage for market value of the property, thinking that you're going to get the market value out if a claim happens. Instead, do this. Always insure for replacement cost. And that means replacement, how much it's going to cost to replace the house. So if you bought a house for $125,000, but it's a 2,500 square foot house, it is going to cost at least $125, $140 a square foot. Ask your local contractor. I'm telling you, that is the case, and you should insure for replacement cost valuation. Yes, it's going to cost you a little bit more money, but it's not going to cost you as much extra money as it would cost to go through a claim that I just described. And then I think keep replacement cost coverage too. I mean, if you insure for replacement valuation for the amount it's going to cost to replace the house, you could say, well, I'll do ACV coverage. And, if I have depreciation on my house, at least I'll get my money back. Just talk to your insurance agent about how much that actually saves you. Because if you look at the difference in price between ACV coverage and replacement cost coverage, it is usually like 4% of your premium. And it's so much better. I mean, it like doubles your payout, obviously depending on your situation. So I'd say insure for replacement cost valuation, keep replacement cost coverage too. And, you could say, hey, well, you're an insurance agent, that's going to make you more money because, it's going to be more insurance premium. You're right. You're totally right. There's nothing I can say back to that. But I am more than happy to articulate to you why I think there is value there. And if you're talking to your insurance agent and saying, okay, show me, these different options, show me the price on these different options and let me talk through it. And then we'll go from there, right? Like there's savings absolutely for these other things, but look how bad it burns you if you have a claim, and like you have insurance, so it takes care of you in a claim situation. So let it do that for you. All right. So what's next? First of all, if you enjoyed this video, if it felt helpful, if you're in a position where you have ACV coverage, maybe you've insured for market value, and you're like, man, I'm feeling pretty bad about my insurance policy right now, give us a buzz. Check us out. We'd be more than happy to, take a look. Sometimes people give us a call and we don't even offer insurance in their state or whatever, and I'll take a look at your policy. Just give you a sense of what you have going, and then, suggest somebody out there that can really help you out. So feel free to check us out at shineinsurance.com or give us a buzz. Obviously, all our contact information is there. And then just 3 things we would ask you to do right here on the channel. If this 15 minutes you just spent with me was valuable, can you please subscribe to the YouTube channel? Hit that subscribe. If you want to have notifications, hit the little bell thing, whatever. I'm good on either side of that, obviously, but please subscribe and please like this video. It just helps other people to be able to know that it's out there. And then let me know what your position is. Do you agree with me? Do you disagree with me? I want to hear it. because I love the comments section on tons of our videos. And if you go to our Shine Insurance YouTube channel, you see a lot of comments and a lot of conversations. We write back to every comment. We'll let you know what we think. If you want to challenge this opinion in this video, please do. It's awesome. I mean, this is all a conversation, and the intention is to help you do a better job of knowing your numbers when you're deciding whether an investment property is going to be right for you, and then succeeding as you move forward in that process. We want to be a part of your team. We are a part of the team of our investment property partners that we insure, and we would love to be a part of yours. All right. Thank you for spending this time with us. I hope it was helpful. Have a wonderful day.